Hey friends, when I purchase a position in my dividend stock portfolio for cash flow that I can use to pay my bills, typically there are two important criteria. The first one is the position, whether it's a stock, ETF, REIT, it must be on sale. I am a bargain shopper. I like to buy value. I like to buy it on discount because the dollars that I deploy, they go further. The second major criteria is, strategically speaking, it must align with the strategic goals in my portfolio. For example, right now I want to boost up in value the energy sector within my portfolio. By contrast, I do not want to add right now to stocks in the sin stock sector because it is way over allocated in my portfolio. So I look strategically. Yes, there are some sin stocks perhaps that are on sale now, but strategically they do not fit into what I am trying to do. So over the last few videos, I have shared some positions that I'm buying right now in 2024 and that I plan to continue buying into 2025. There are 5 of these positions. I'm going to recap them in a minute. But what I want to do in the video today is I'm going to share 2 more positions that I plan to buy right now in 2024 and into 2025. Actually, one of them I already bought recently. My patrons already know this, but one of them I'm kind of earmarking for 2025 once it goes on sale perhaps, because right now it's a strategic position, but it's not yet on sale. It was on sale a few months ago, but I missed the sale because I had other priorities at the time. So I'm going to uncover these 2 positions in the video today to add to my watch list, to my buy list, because I'm really excited right now as a dividend stock investor. I am so excited. 2025, it is going to be, in my opinion, a great time for me personally because I see a lot of these positions on sale. I see kind of dividend stocks being out of favor right now. I like that as a dividend investor because it gives me time just to accumulate shares, units of these positions at discount prices. Get ready, everyone, for a really exciting dividend stock investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So I want to start out today just sharing all 7 positions. I'm going to recap the 5 and then I'm going to go into the 2 net new ones. The 7th position, it's really going to surprise some of you. Check it out on the screen right now. And so all of you know that my top priority for 2025 is SCHD. SCHD is the Schwab US Dividend Equity ETF. It's currently actually about 3.2% of my portfolio right now. My patrons already know this. I'll link to my Patreon in the pinned comment below, but I recently sold my Hawaiian Electric shares. Maybe I'll cover that in a future video. I don't want to spend too much time on it today, but I sold Hawaiian Electric and I used the proceeds to buy more SCHD. Because of that, SCHD is now about 3.2% of my portfolio. Strategically, I want it to be about 6 to 9%, maybe even by the end of 2025. That's going to be a hard feat to accomplish because it will require a lot of capital being deployed. It will require a lot of selective reinvestment into SCHD, but I believe it is possible. What I like about SCHD right now is it really hits the 2 imperatives that I discussed earlier. I believe it's on sale. It's at a bargain value price because the underlying positions are at bargain value prices. It has a high starting yield as a result. And strategically, it fits into what I'm trying to do right now. I'm trying to diversify and gain exposure to industries in which I lack exposure, like financials, which are a big component of SCHD. So that one I've already covered a lot. That's it for today. But as you can see on the screen in front of you, let me just recap the other 4 really quickly before I get into the net new 2 positions that I'm adding to my buy list. And so Pfizer, you all know, it's only 0.8% of my portfolio. My goal is no more than 2%. I like Pfizer here because of the high starting dividend yield. One of the things about Pfizer, though, is it's risky. Hence, I don't want it to be more than 2% of my portfolio, but I like that it's in healthcare. Strategically speaking, it's in a category where I could stand to have more exposure. Next on the list, you see Realty Income. Currently, it's about 4.2% of my portfolio. My goal is about 5 to 6% of my portfolio. It's on sale now. It's on sale now because the 10-year Treasury has gone up in yield, and REITs oftentimes trade as a reflection of the bond market. And quite frankly, cost of capital right now for real estate deals is high. And so REITs are adjusting, like Realty Income, to reflect that. I just did a blog post about that on my Patreon as well. Link to that Patreon in the pinned comment below. But Realty Income for me, I believe it's on sale right now, and it has a high starting yield on a price divided by AFFO basis. I've covered this in my other videos, which I'll link to in the pinned comment below. It's trading at a value level, but again, it's strategic for me. It's strategic because it allows me to have more exposure to REITs where I'd like a little more exposure to REITs within my dividend stock portfolio, and I view it as a no drama sector. Let me share two more. As you can see on the screen, this is just recap, but I think this recap is helpful because it shows you how I approach things strategically in my portfolio. The reason I want to do this recap is it shows actually on the next two, J&J and PepsiCo, number 4 and 5. These ones, honestly, they're not that strategic for me right now because I'm over allocated to them. Their values, I see them trading at good value prices. I covered them in my last video, which I'm going to link to in the pinned comment below. But honestly, J&J, it's currently 7.4% of my portfolio. I don't want it to be that much higher in the portfolio, but I have to add a little bit more to it because as I'm adding to other positions, I don't want it to shrink in size as a percentage of the portfolio. Same with PepsiCo. It's about 6.7% of the portfolio, and I'm adding to it a little bit here. I shared some of those trades over on Patreon recently. I bought some of these for myself as a Christmas gift. But again, PepsiCo, I don't need it to get too much bigger in the portfolio. Strategically, that's not an imperative, but I would like to maintain weight at least, so I need to add a little bit here to keep it at a current percentage allocation as I deploy more funds across the portfolio. But with J&J and PepsiCo, with these two, I see them as values. I see them as discounts, but they're not strategic imperatives of mine. They're not necessarily sin stocks per se, which are definitely kind of a no-go for me here because I'm way over allocated to them. But with these two, I'm pretty well allocated to them. Maybe J&J, I feel a little better adding to it because it's in healthcare, whereas a sector, I'd like to see more allocation to healthcare. But the amount of money I'm deploying to those two, it's lower. It's certainly lower. I want to deploy more money, certainly more to SCHD and more money to Realty Income and probably even more money to Pfizer than I am right now to J&J and Pepsi just for strategic reasons. But here we go. This is where it gets exciting. This is kind of new ground to cover. There are two more positions I'm adding to this buy list. And it's funny. Dividend investing. I shared the two imperatives. It has to be on sale. It has to be strategic. You may remember a while ago, I'll link to it in the pinned comment below, but I did a video on Chevron. Chevron a few months ago was in the $140 range. Very, very quickly after President Trump got elected, the energy sector, it did really well. And these particular stocks like Chevron, they went up in price. And so it was in the 140s. It went all the way up to the 160s. It kind of left my buy range. This goes back to those strategic imperatives. Chevron strategic. I want to boost it in the portfolio for the sake of diversification. But from a value standpoint, I wasn't seeing the value at Chevron anymore. I was seeing it in the 140s, not in the 160s. So I had to be patient. I was patient and it came back down. It came back down in share price. And so as you can see on the screen in front of you right now, just real quick summary, you can see the two new positions I'm adding to the buy list there. And with Chevron, it's back on the list. I bought some more recently. It's currently about 1% of the portfolio. And I want to get it up to about 3 or 4%. Now, could I do that in 2025? Maybe. It would be at the detriment, though, of SCHD, probably. I'm going to focus on, let's first get it from 1% to 2%, but that goal of 3 to 4, maybe that'll take multi-year, we'll see. But you can also see on the screen now, I've got number 7, which is Alphabet or Google. Currently, that's 0% of the portfolio. The goal is to get it to 0.5%. And so I could see that happening possibly in 2025. Here's the thing about Alphabet. It was on sale a few months ago. I didn't buy it a few months ago because I was focused on cash flow. Here's the deal. Alphabet for me, it's hits that kind of imperative of being strategic. I lack tech exposure in my portfolio. I want some. I can only do it though if it's paying a dividend. Thankfully, Alphabet is paying a very small dividend now, but I see it possibly increasing that quite aggressively over the decades. From a value standpoint, I don't see the value there right now, so it's going to be on hold for a little bit here. If in 2025 it exhibits value again, I see a value bargain buying opportunity, then I'm going to buy it. If I don't, I won't. I'll just wait, like I did with Chevron. I was buying in the 140s. When it went up to the 160s, I decided to wait. It's back down in the 140s. I'm buying it again. That's how I have to operate as a dividend stock investor. Yes, there's exceptions where I pay up for quality and I just buy it full price, but kind of where I'm at in my journey now, I don't do that as much anymore. 7 positions. There are even more. I didn't want to really list them today. Those are 7 right now. And I'm excited because just a few months ago, I couldn't pick as many. Maybe I had SCHD and Pfizer, like I said in the first video of this series, but over the subsequent months, the market has been strong, but value stocks in general have not, which has created a buying opportunity that I'm excited about. So I want to share on the screen really quick, as you can see in front of you right now. Let's just go over Chevron and Alphabet really quickly. I just have both of them on the screen right now just to save everyone some time. I'm trying to make these videos a little bit shorter because I think that is just better. It seems that's what the community likes the best. So Chevron, you can see there, price per share $144 right now. It's down from the 160s. I love it. What I really want to highlight about Chevron right now is the forward PE ratio for 2024 is 13.71. 2025 is 12.59. Keep in mind right now that the forward PE for the S&P 500 is about a 22. And so this is trading at quite a discount to the S&P 500. But of course, you all say, this is an old school company. It's nothing like Alphabet. It's nothing like Meta or some of these more exciting stocks that are growing quickly. Of course, it has a lower PE. But this is where I think the market is wrong. I love it when I see something in the market that I don't agree with, and I'm kind of the only person or one of the only people that sees that, because it sometimes is a buying opportunity. And that's what I believe is the case in Chevron right now in the 140s. And here is why. As you can see on the screen, I actually shared this in my Chevron video a few months ago. I'll link to that in the pinned comment below. But you can see here the main metric I want to show is on the right, free cash flow. Stocks in general are a reflection of the free cash flow that they can generate. You can see here 2022 through 2027. Their free cash flow is going from kind of 10 billion range up to over 20 billion. What they're saying here in the middle at the bottom, expect greater than 10% free cash flow average annual growth. They're saying in general, the CAGR, if you will, on their free cash flow, they expect to be 10% or more per year on average going forward through 2027. I believe that this is a metric a lot of people are missing. They're just missing. We have a stock trading at a PE in the 13s and 12s, but they're growing free cash flow by 10% per year on average. I don't even know if those stocks at the top of the S&P 500 that are really pulling the entire index, if they're even doing that on average through 2027. That will be really interesting. And so I see the market kind of mispricing here. I think there's a lot of hate towards these kind of energy sector stocks, this older kind of world of stocks, but I don't really see energy demand on a global basis kind of going away anytime soon based on the studies that I've read. And I think that their projections could be possible. And if they can grow the 10% free cash flow growth year over year over year, we all know in a dividend investing community that even growing, even compounding 7% over time can do wonders. 10% compounding that over time, that can not only do wonders, that can perform miracles. And so, as you can see on the screen in front of you right now, with Chevron, I'm really excited about it because I lack exposure to energy, and it's 1% of the portfolio. I'd like it to get bigger. Now they're growing the dividend on average by 6.49% per year. Maybe they can grow it even quicker with that really fast free cash flow growth, but I actually think they'll probably keep the dividend growth around that 6-7% range, because I think with the added free cash flow, they actually will be probably doing increased buybacks. At least that's the sense I get, which is just fine for me if they're buying back their stock at value prices. Now, the starting yield is 4.53% on a qualified dividend basis, which is amazing. I put a footnote at the top of this too, that energy, it's about 2.6% of my portfolio because I have other energy stocks. The one risk with this focus on Chevron, say bringing it up from 1% to 3% of the portfolio, the risk with something like this is that if they have a problem, an energy, an oil spill, if you will, there's a lot of risk not being diversified in energy. And so that's the risk with me kind of focusing so much on Chevron versus maybe buying a basket of energy companies. But I just like Chevron. When I look at the fundamentals of Chevron, I think it's a superior company to some of the other energy positions I own in my portfolio. And that's why I'm focused there. Anyway, if it jumps back up to the 160s, I'll wait. But as long as it's in the 140s or lower, I plan to average in, dollar cost average, slow and steady, brick by brick. That's how I do it. I can't foresee the future. Maybe the market will drop from here. I hope it does. If it does, I'll buy at lower prices. I'll get a higher starting yield. It works out in my favor because when I buy dividend stocks, I said this a long time ago, it's important to really reiterate this. I don't really look for capital appreciation. It's really nice. I like it because it feeds my ego, but I just kind of look at the money deployed as a sunk cost. When that money's there, it's gone. I don't have it per se anymore. It's in the stock because I don't plan to sell. I am buying for a growing stream of cash flow over time. And so anyway, if stock prices go down, yeah, it kind of hurts the ego. Portfolio value is down. But again, I'm looking towards the future. I'm looking at buying streams of income, and I get excited to buy higher streams of income for less capital deployed. Let's keep going. As you can see on the screen, again, on the right-hand side of the screen, I have Alphabet. This one right now, it's trading at a forward PE of 24 for 2024. So it's trading a little bit higher, it looks like, than the S&P 500 forward PE, but it's a little cheaper than some of the other tech stocks out there. Honestly, one of the reasons I'm enticed to buy Alphabet is I do so much work here on YouTube that I just want to own a piece of kind of the platform that means so much to what I do. The other big reason is I've wanted to own this stock for a long time, and finally a few quarters ago, they did the impossible. They initiated a dividend. The dividend on an annual basis right now is only 0.42%, and the payout ratio is a very low 10%. But kind of like Apple, which is a stock I used to own, I sold, maybe I'll buy back one day. I sold that one to raise money for a real estate deal. Otherwise, I wouldn't have sold it. Like I said, I rarely sell stocks. Hawaiian Electric is another exception. I sold that one because they cut the dividend and I don't believe it's coming back anytime soon. And so that's kind of another corner case. I went through that a bit on my Patreon, which I'll link to in the pinned comment below. But anyway, with Alphabet, I believe there could be some dividend growth, strong dividend growth over time. And I kind of look at it as a opportunity just to have some exposure to tech. Even if I can bring this up to 0.5% in my portfolio, it's something other than nothing. Yes, I have tech exposure through Big Blue, IBM, but I don't know. And it's done really well actually in the last year, which is great. But I'm saying through a company like Alphabet, kind of through one of those stocks that's at the top of the S&P 500, I don't have that in my portfolio. So just getting off zero, it's kind of a strategic imperative of mine. But again, it's not on sale right now, so I'm just going to wait. I have other priorities while I wait, like SCHD that also has tech exposure. Let's, though, do some interesting summary here on just dividend investing in general. I think I want to bring this all home with one more slide. As you can see on the screen in front of you right now, check it out. So this particular screen shows some thoughts about dividend stock investing. So I already talked about the first two. Strategic selections must be on sale, must fill a need in the portfolio. But dividend investing, I touched on this, but I want to go into it more. I buy and hold forever. When my capital is in, it's as good as kind of gone in my mind because I don't plan to sell. I'm buying for growing streams of income. So again, some repeat. But I want to talk about capital appreciation because I get a lot of comments here. Ian, what you're doing, it's not the right strategy. You're leaving money on the table. You can make more through capital appreciation. Look, I have a strategy that works for me. I'm sharing my personal journey here on YouTube for fun and entertainment. There are so many great strategies, and who am I to put down another strategy? I think everyone will find the strategy that works for them and works for their level of risk tolerance. This one works for me. Here's why. As you can see on the screen, let's just look at capital appreciation. I realize, especially with 2024, it's possible to maybe have higher returns with a capital appreciation focused strategy. Over the very long term, though, dividend growth stocks have held their own. When you look at total returns with both capital appreciation and dividends, they've done quite well as compared to the S&P. But maybe things are changing. 2024, a lot of people are waking up and saying, hey, it's all about capital appreciation. Ian, what are you doing? Look, I realize that. I realize in more recent times, capital appreciation, it's done well, and I commend people who have a strategy like that works for them. That is fine. I respect all strategies, but I'm investing, look, for my personal situation and my personal level of risk tolerance. Right now, the S&P 500 has a very high PE ratio on a current basis, which is like 27 plus, and on a forward basis, which is like 22 plus. It's at a very high level. For me, I don't feel comfortable investing that way, even if there is a lot of perceived growth, that there's a PEG ratio adjusted for growth that's lower. It's more normalized to a level that makes sense. I don't care. I don't feel comfortable for my personal situation, but if others feel comfortable, great. That is awesome. Check it out on the screen right now. So what I want to say is I'm investing for my personal situation. I don't also need a higher return. Here's the deal. I'm getting further along with my dividend investing. As I have gone through this for decades, I'm in my 40s now. I've been doing this for decades, and I've been deploying money in good times, in bad times. I try to always buy value. There's always pockets of value in the portfolio, and I like to do that. I got some value last year in the SIN stocks, for example, and in Realty Income. But here's where I'm at. Because I'm kind of getting closer and closer to my goals, why would I even need higher returns? I could theoretically do that by maybe taking on some more risk, but I'm fine. I'm going to live comfortably, and I'm going to have dividends paying fully for this comfortable lifestyle. And I can see the light at the end of the tunnel. So for me, in my situation, I don't feel comfortable taking on more risk, and I'm just happy with the strategy that I found for myself that works. Now, I know this strategy may not work for everyone, and so that's why I'm addressing all of those comments I get about capital appreciation. There may be other strategies that work better for you, and if there are, you've got to follow your own heart. I'm not offering investment advice. I just share what I'm doing for fun and entertainment. And so with all of that, if you enjoyed the video today, please go ahead and click the like button. It means the world to me. Happy 2025, everyone. I'm so excited for the new year. I hope it's going to be the best year ever for dividend stock investing. And when I say best year ever, I don't mean stock prices going up. I hope they go down or kind of hold where they are. That's best year ever for me. That's how I look at it as a dividend investor. If you enjoyed the video also, please don't forget to subscribe. Before I go today, in terms of a full disclosure, I do own the stocks and ETFs and REITs mentioned today. In terms of full disclosure, I'm long SCHD. I own that stock in my personal dividend stock portfolio. I own Pfizer, ticker PFE as well. I own Realty Income, ticker O. I own Johnson & Johnson, J&J. I own PepsiCo, PEP. I also own Chevron, ticker CVX. I also own Big Blue, IBM, ticker IBM. I'm long treasuries, and I plan to add shares of Alphabet, ticker GOOGL, in my portfolio at some point in the future, but it's probably going to be way into the future when there's a buying opportunity and when I get through some of these other strategic imperatives first. I own those positions just mentioned in my personal dividend stock portfolio. Before I leave today, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market, and please consult your licensed investment advisor before making any financial decisions. I'm not offering advice. I'm just sharing my journey for fun and entertainment. I love you all. Thank you for watching. I'll see you in the comments below. Happy 2025, and I'll see you in the next dividend stock investing video.